Okay, let's talk about the elephant in the room. Since hitting that glorious all-time high in October of last year, Bitcoin and other major cryptocurrencies have halved in value. We watched the collective market cap plummet from a staggering $4.4 trillion down to just under $2.2 trillion. Those numbers don't even tell the full story because the US dollar has also been falling, making crypto charts look better than they are. If crypto was supposed to be a currency, the majors have lost almost 50% of their purchasing power in just the last month alone, putting them dangerously close to the technical definition of hyperinflation. If it was meant to be a rock-solid store of value, think about this. Last year, 1 Bitcoin could buy 32 ounces of gold, but today, less than 12 ounces. And if it was meant to be this rebellious alternative to get around the financial system, it's pretty awkward that most trading now happens on centralized exchanges. Even weirder, the government it was supposed to replace has been floating the idea of a crypto bailout, which is exactly why Bitcoin was created. Now, I know what the veterans are thinking. We've been here before. Bitcoin and its crypto cousins have seen dramatic declines following events like Mt. Gox imploding, the Silk Road getting seized, China banning crypto again, and FTX going up in flames. And let's not forget the moment we all admitted NFTs probably weren't the asset of the future. Every time the market bounced back and set a new record, it was used as irrefutable proof to say, "I told you so," usually accompanied by glowing laser eyes on Twitter. But today, my friends, crypto is facing a brand new, terrifying challenge: legitimacy. It turns out that a few months of unrestricted compliance might actually kill what a decade and a half of fraud and crime couldn't. Let's break down exactly why this crash is completely different and why it might finally be time to admit that this whole thing was just a little bit silly. The first big reason this time feels different is simply that there is no single villain behind this price slump. Think back to the major market sell-offs of the past. They almost always lined up with a highly identifiable, headline-grabbing disaster. In 2011, it was the infamous hack on Mt. Gox that crashed Bitcoin by over 93%. In 2013, it was China banning financial institutions from touching this stuff. In 2017, it was the catastrophic fallout from the ICO mania. And in 2022, the so-called stablecoin Terra Luna turned out to be very unstable, crashing to $0 in 48 hours and wiping out a $40 billion market cap. But today, there is no single identifiable catalyst that kicked off this correction. There's no massive hack, no sudden government ban. Instead, there are just a few persistent headwinds. And unlike the dramatic crashes of the past, these variables are unlikely to be going anywhere anytime soon. The second reason people think this time is different is a bit of a tough pill to swallow. The true fanatics have packed up and moved on to other opportunities. Let's be brutally honest for a second. Throughout its short history, the number one reason people bought crypto wasn't because they were deeply passionate about a democratic, decentralized system. It wasn't because they wanted to build the future of finance, and it wasn't even to buy questionable stuff on the internet. The real reason people bought crypto is because they believed they could sell it later for more money than they bought it for today. And hey, there is absolutely nothing wrong with that. That's why anyone invests in anything. But crypto was uniquely attractive because it was so incredibly volatile. It offered the perceived chance to make a life-changing amount of money in a very short time, effectively acting like a casino where a small bet could yield a massive payoff compared to boring old stocks or real estate. But today, people can get that exact same thrill by just gambling. The explosion of legalized sports betting, prediction markets, and crypto casinos has given everyone a much easier outlet to YOLO their savings. A lot of people have quietly cashed out their crypto investments just to bet on sports. You might have heard the term financial nihilism floating around lately when people feel they can't reach their goals with slow and steady savings. They take massive risks, hoping to catch up. In the past, these unsophisticated thrill seekers provided the crypto market with massive liquidity and built the entire culture, aggressively defending their bags online. But today, a lot of that core demographic has just slowly lost interest. All right, so the gamblers left. Who replaced them? Wall Street. And ironically, this might be the biggest shakeup to the crypto market yet. Today, getting your money into crypto is ridiculously easy. Complete novice investors can get exposure through exchange-traded funds. or ETFs, with massive institutions like BlackRock acting as the middleman. For a while, this fresh money drove prices up. But let's think about this logically. Someone buying a BlackRock-managed Bitcoin ETF on the Nasdaq is statistically not a true believer in the anonymous, decentralized revolution. This is literally the most centralized, formal way you can buy anything. They're just treating it like any other boring asset in a diversified portfolio. To make it even sweeter for these new investors, financial products were created that actually pay dividends on top of these crypto holdings. Now, if you're scratching your head thinking, wait, Bitcoin doesn't pay dividends or produce cash flows, congratulations, you've thought about this more than most investors. The way these funds generate a return is by selling covered calls to other speculators. The speculator pays a fee for the right to buy Bitcoin at a set price in the future. If the price doesn't hit, the fund passes that fee to investors as a dividend. Sounds like free money, right? But if the price is reached, the fund is forced to sell, effectively capping the capital gains. Even worse, crypto option market makers hedge their positions by selling the underlying asset. This puts constant downward pressure on the market price. Because of all this mainstream adoption, crypto has entirely lost its story. It used to be this cool anti-establishment rebellion. We were promised that once the SEC stopped fighting it and big banks held it, we were all going to be rich. Well, that all happened, but its use case hasn't changed meaningfully. It is still overwhelmingly just a speculative asset to sell to the next guy. With some fringe use cases for fraud or money laundering, the promise of we're all going to be rich when this happens is gone, because there is nothing left to happen. So, the retail folks went to sports betting, and Wall Street made it boring. What about the big tech money? Well, they found a shiny new toy: artificial intelligence. The people with a lot of money who want big returns have moved straight to AI. AI data centers are physically crowding out crypto mining operations for energy and cutting-edge hardware. Because right now, there is simply more money in generating AI slop than there is in generating crypto. They both need massive energy and specialized data centers, so more resources for AI means fewer for crypto. Because of this, the direct and opportunity costs for mining have shot up. Network stability has suffered, and people are waiting longer or paying more for transfers. And we really need to talk about the environmental cost here. Energy demands from Bitcoin were roughly the same as the increased demands from AI, both sitting around 150 terawatt-hours per year globally. Bitcoin alone generates 30,000 tons of e-waste every year as miners burn through specialized hardware. Now, AI might end up being an overpriced bubble, but at least it gives us tools to do tedious tasks. The true utility of crypto, for comparison, has mostly just been fraud and money laundering. Let's strip away all the hype and go back to square one. What is Bitcoin actually supposed to do? In the original 2008 white paper by Satoshi Nakamoto, Bitcoin was clearly described as a peer-to-peer electronic cash system. It was supposed to be digital money. But economists have three basic rules for what makes something money, and Bitcoin brutally fails all three. First, it has to be a medium of exchange. The Bitcoin network processes roughly 500,000 transactions a day. Visa, they process roughly 65,000 transactions every single second. Visa could clear Bitcoin's entire daily volume in under 8 seconds. Plus, a single Bitcoin transaction uses the same amount of electricity as an average American household uses in 43 days. Second, it needs to be a store of value. It needs to be stable. But Bitcoin can swing 20% in a single month. Also, talk about centralization. Roughly 2% of addresses control 95% of the supply. When ownership is that top-heavy, the market can be easily manipulated by huge holders. Just look at the recent lawsuit where Jane Street is being sued for allegedly helping trigger the 2022 crypto winter, wiping out $40 billion in market value. Third, it has to be a unit of account. Even businesses that accept Bitcoin don't actually price their goods in it. They price in dollars and just convert it at the register. Meaning Bitcoin is just temporarily passing through the transaction. And if you're yelling at your screen that we haven't given it a fair shot yet, we actually did. In 2021, El Salvador made Bitcoin legal tender. The government launched a wallet called Chivo, required businesses to accept it, and gave everyone a $30 bribe in free Bitcoin. The results? A massive belly flop. Bitcoin accounted for less than 2% of El Salvador's remittances. 60% of users downloaded the app, took their free $30, and never made another transaction. Today, a whopping 66% of the population considers it a failed project. So, here is the harsh reality. If it fails as a medium of exchange, a store of value, and a unit of account, where does the price actually come from? Once you strip away the marketing, ignore the memes, and turn off the Twitter noise, you are left with a very old concept in finance, the greater fool theory. This theory states that the price of an asset doesn't need to be justified by its actual underlying value, as long as there is a greater fool willing to buy it from you later for a higher price. Bitcoin doesn't generate cash flows like a stock, and it doesn't produce goods like a commodity. The price is entirely dependent on the belief that someone else will pay more for it later. Every narrative you have ever been sold, whether it's digital gold, the future of money, or an inflation hedge, serves one specific purpose: to create new buyers. Because the absolute second that new buyers stop entering the market, the entire machine breaks. It's entirely supported by hope. It is the largest real-time experiment in the greater fool theory the world has ever seen. It might not be today, and it might not even be tomorrow, but eventually, you will run out of greater fools. Thanks for hanging out with me today. Make sure to like and subscribe to keep learning how money works, and I'll see you in the next one.